What is a special purpose acquisition company? Otherwise known as SPACs, or you sometimes hear them also referred to as blank check companies. You can think of a SPAC as basically a big pile of cash with a ticker symbol on it. So what investors get when they're buying a SPAC is they're actually buying a shell company that has no real commercial applications. You'll pay $10 usually for one publicly traded share of this SPAC, and then the management company who's running the SPAC is going to accumulate cash. It's a way of raising capital. So they get a big enough pile of cash that they're going to go out and they're going to try to buy a private company and take it public. So you as the investor gets in on the ground floor of a private company going public, and have access to any potential growth that might thereby bring you. Of course, the major drawback to this is you don't really know what you're actually buying. SPACs in this last year have been a major growth industry. So you're looking at $65 billion went into these special purpose acquisition companies last year. You had almost 125, something like that, of these new companies that came to the market. So you're looking at one that was coming every 2-3 days all last year, and that trend has continued into 2021. Partly it's because you have a huge amount of appetite for risk in the market these days that hasn't always been there. Last year with COVID shutting down a lot of the casinos and the sports, so the betting on online sports disappeared. You had a lot of gamblers who had all of this excess entertainment money sitting around at home, and they started to look at the ticker symbols of stocks on their computers while they were doing so. So the stock market became the recipient of a lot of this excess kind of casino culture type of investing. And SPACs were a great way for these people to sort of gamble. There's a big amount of appetite not just for SPACs, but also IPOs, or initial public offerings. So companies that especially had name recognition, so think of like your DoorDash or your Airbnb, those big kind of unicorn type of businesses that went public last year. They were massively oversubscribed. Investors really desperately wanted to get in on the ground floor of that. But because there was so much interest in them, by the time these companies went public, the stock price took off. So opening bell, you weren't getting in on what the initial stock price offering was at. It was double by the time that you could buy in. So SPACs offered a way for investors to actually bypass this. And you can still see interest in those types of private companies today. I get asked a lot about a company like SpaceX, for example. That's a private company that you can't buy into. And normally, as an institutional investor, you could get in on a private offering. But as a public investor, as the general investor, you don't have the capacity to get in on these private companies. They require either you to know someone or be involved in the company somehow, or they require a huge amount of access or a huge amount of dollars that you can actually lock up for up to 7-10 years in order to get in on these private offerings. Which is good news in the sense that it gets you in on the ground floor, but it also means that you don't really know what you're buying. Because as I said, all of that capital that you invest is being exchanged for a public share of a company, which you don't know which it's going to be yet until the SPAC actually goes out and buys a company and exchanges your shares. So normally you pay the money, $10 a share gives you one publicly traded company, and then the SPAC has up to 2 years to actually invest that money. Hugely popular because of the huge increase in risk that investors seemed to find last year. And then secondly, also the marketing behind SPACs really changed. You saw the financial industry, for the first time that I can remember, follow the general business industry, and that the way that a business product is sold right now is by going out and purchasing social influencer support to actually endorse your product. So if you're going to sell your shampoo or fitness products or clothing, there's an algorithm out there that social influencers follow, where you're selling on TikTok or Instagram, and they follow this preset formula or template to sell the products, and it's proven to work. Well, now that same sort of template is being applied to the financial industry. So you're starting to see these celebrity endorsers with all their millions of followers not just endorsing shampoo, but they're coming out in favor of financial instruments or SPACs. So you had Shaquille O'Neal and David Robinson and A-Rod, these retired athletes, they're coming out and promoting these special purpose acquisition companies. You even had some retired politicians, Paul Ryan and Delaney, both came out supportive of these SPACs last year. It's a template that is proven to work. One of the pioneers, not of SPACs in general, but of that sort of whole marketing campaign around how to sell your SPACs, came about from a guy named Chamath Palihapitiya. Chamath is actually a Canadian. Did his university at University of Waterloo, hired by Facebook, moved down to Silicon Valley, tremendously successful in a bunch of endeavors down in California. Eventually went off on his own, and he's been running these SPACs for a while. But the way that he is actually going about selling these SPACs is through social media. So Chamath has a weekly podcast. He's got 1.5 million followers on Twitter. I don't know how many he's got on Instagram. But he's using those platforms, one, to get his message out, and he's a controversial figure, constantly rallying or railing against the insider on Wall Street and how anybody's going the traditional IPO route is a fool, and investors that are using traditional brokerage houses are wasting their money and they're sheep, and he's got this platform that he's jumping up and down saying, the best way to invest is through these SPAC companies, specifically the ones that he is endorsing. He also has the twist that he is not simply acquiring money for the sake of money. He's a part owner of the Golden State Warriors, and he's got enough money that he doesn't need to make anymore. But his purpose in acquiring more money is that he wants to affect real social change. So he's looking at items like social injustice or equality and climate change as things that he wants to make his money for. Whether or not you believe that doesn't really matter. The fact of the matter is he's been tremendously successful in building that narrative, and he has millions and millions of followers who are piling money into these SPACs that he's going on. He's got IPO-A, which is the very first one that he launched at the beginning of last year, was for Galactic Virgin, which is that Richard Branson sponsored space exploration company. So Richard Branson has this company that will basically, for 6 figures, will take tourists up into space so that they can see Earth. And that was Chamath's sort of first IPO that first SPAC that he launched, and the first company that he brought public through that mechanism. And that has spawned a whole bunch of these SPACs that are going forward. Now, that's another thing that has sort of contributed to the popularity of them, is that they all tend to be in areas that are sexier than normal. So you're looking at space exploration, and you're looking at EV vehicles, electric trucks, and you're looking at human genomics, and you're looking at robot maids and flying taxis and things like that. And so it kind of captures the attention of the average investor out there on the street. So this social media sort of marketing campaign around them, plus this increased appetite, means that it's a tremendously popular field right now. Now, there are, of course, risks in investing in SPACs, and I would say they're a lot higher than more traditional investments. First of all, as we already touched on, you have no idea what you're actually buying. So you give your money, and you're not really buying a company. What you are is you're actually investing in the manager who's running the company. You're investing in the Chamaths or whoever it is that is actually launching the SPAC or launching that blank check company. And you're hoping that they do a good job of picking the company that you're going to partner with. The second thing that you have to worry about is that they tend to be in these sexier sectors, which sounds great, except there's so much more risk in sectors where you don't really have any sort of history to take a look back on to see how similar companies have done, because it's all kind of brand new territory. Warren Buffett made an interesting point last month at his shareholders meeting when he was sort of equating the new market in EV vehicles to when the auto industry first came about, and how the technology behind autos or automobiles was obviously fantastic, but there was hundreds of companies that were trying to take advantage of that early technology. And you fast forward 20 years, and those hundreds of companies had narrowed themselves down to just 3 companies. Same thing's going to happen with a lot of these early adoption sectors, whether it's space exploration or robotics or human genomics, is you're going to see, the idea is not enough. Eventually, there's going to emerge clear leaders that are going to cut out the competition, and there's going to be a sort of culling of the herd in these sectors. So very, very high risk sectors that you're looking at. Another thing that you have to be careful of is these SPACs were originally the domain of institutional investment. They're not new. They've been around for a while, but they were originally written as a way of getting big, large institutional money into the investment market with private companies. But as such, the shareholder agreements are quite complicated. So you're looking at the big institutional investors or the SPAC sponsors are taking 20% of shares before the company even ever goes public. So that means there's a dilution of shares for the individual investors who jump on board after that. So the fee structure tends to be fairly onerous, and understanding the shareholders agreement and where you are in the life cycle of that SPAC from the initial phase where that's just a big pile of cash to the rumor phase where now you're starting to see there's rumors that money is going to go to ABC company, and you see the building of the stock to the actual completion of the company and when they actually sign an agreement. And usually, surprisingly enough, even if that signed agreement is with a company that was originally supposed to be signed with, you see the value of the shares drop at that point. And then hopefully when the company actually does go public, they ramp back up again. But again, huge risk in that. Finally, you're very reliant on the individual managers to properly do their due diligence when it comes to the investments. And they've got reputations that they have to uphold, but at the same time, one of the contingencies or one of the things that goes along with these SPACs is there's a 2-year window whereby those guys have to buy a private company for their SPACs, or they have to refund all the money back to their individual investors. Warren Buffett is also famous for sitting on massive piles of cash for years and years because he's unable to find a partnership that he's comfortable with in terms of putting that cash to work. So companies that don't pass his due diligence, or companies that he doesn't feel correctly fit the ideas that he wants for his Berkshire Hathaway company. And so 2 years may sound like a long time, but it's not really. And you really run the risk is if someone puts a gun to the head of a manager and says, hey, you have to buy a company in 2 years, he's going to buy one. Whether or not that company is actually something he believes in or not can oftentimes be open to, I'm going to say, interpretation. The final thing that you really got to be worried about is because these are all private companies that you're buying, they have no earnings. So you're really reliant on forward-looking guidance from these companies. And a forward-looking guidance is basically, it's carte blanche for these companies to stand up there and brag and misinform, we'll call it, if not outright lie about where their product actually is in development or the potential that they really see. Interestingly enough, it was a record year for SPACs last year, record year for these types of investments, 10 times bigger last year than the next closest year. But it was also a record year for fraud claims against companies. There was I guarantee you those go hand in hand. It was a record year for companies kind of coming out and outright lying or misinforming about where they actually were in their product cycle. So when it comes to special purpose acquisition companies, super interesting field, really entertaining. I love following it just for the entertainment value alone. But you have to remember that it's very firmly in the speculative part of your portfolio. Like this is gambling money. This is not investing money. And if you can separate that out and say, I'm okay with a part of my portfolio being entertainment, and I'm okay with a part of it being speculative, then SPACs are something that might be worthwhile looking at. But if you're looking for investment, if you're looking for something that you want there for the long term, if you're looking for money that you can count on, it's not money that I would be putting into SPACs. Thank you. Hope that helped.